Hi dear Career Links, Atsanas here. Today I wanted to walk you through three of the reasons why you should not be trading during the day of an FOMC announcement, and another six reasons why you should not be trading during the announcement itself. So the three reasons why you should not be trading during the day are: first, anticipation and speculation. So the hours leading to the FOMC announcement are often rife with speculation and anticipation. Traders are trying to place bets, and this usually can lead to erratic market movements. The second reason is because there is the so-called pre-market stagnation. So before the FOMC's decision, markets can become unusually stagnant, and with traders usually holding off on making significant moves until after the announcement only. So this is the second reason. And the third reason is the sudden volatility spikes. So once the FOMC decision is released, markets can experience sudden and extreme volatility. That's the reason why I don't usually trade in the first 10 to 15 minutes of an FOMC statement. I can only trade once the announcement is out there and maybe 15 minutes later. Okay, and now about the six reasons why you should not be trading the FOMC announcements itself. So first, the high volatility. FOMC meetings often result in significant market volatility. So moves like that can easily take you out. The second reason is increased uncertainty. The outcomes and implications of FOMC meetings can at times be uncertain, not to say most of the times. Then liquidity fluctuations is number three reason. So around the time of the FOMC announcement, liquidity fluctuations can be wild. I mean, if you think that's a 20 point move is a crazy move, then you should definitely check out an FOMC announcement and definitely try not to trade it. The next reason is emotional trading. So we're only human, so it's very hard for us to put a stop on an emotional trade. That's why we need to have rules in place. The heightened atmosphere surrounding the FOMC meeting can lead traders to make decisions based on those emotions rather than the strategy. So that's why you should try to avoid trading the announcement directly. Another reason, which is our fifth reason, is the spread widening. So usually brokers widen the spreads around the major economic announcements. That's how they also make money. You also have other technical reasons like the increased volatility and risk. They need to hedge themselves against those. So there are different reasons for the spread widening, but usually that's one of the major effects as well. The last reason is the difficulty in technical analysis. So this is reason number six. The market's reaction to an FOMC meeting can disrupt technical patterns and usually invalidates analysis. That's why I like to place my trades, if I'm placing any trades around the FOMC meeting, only after the announcement is out, and I'm waiting usually 10 to 15 minutes for the markets to kind of balance out the news, and they still are liquid enough so they can give us good opportunities. So now on to the main part of this video, where I'll show you a couple of trades and what happened during the day of the FOMC meeting yesterday. Hi guys, I just wanted to give you a bit of intro from the day trading room and share with you that it actually has been tough couple of days, and I was being stopped out on a couple of trades after taking initial profits. So in other words, if I'm to illustrate that, the price went in my favor. I took half of the trading profits, and then the price went against me and stopped me out on one of the trades. And the other trade was the stop loss was hit very not very quickly, but like maybe in the first half an hour of taking the trade, which is unusually long time for the strategy that I'm using. So on average, we have 80 to 85% of the trades, they hit the first targets at 1-to-1 very quickly, meaning in the first 3 to 5 minutes. So in this day it was quite extraordinary, since I took the trade here, and you can see it's 17,080, and this was a DAX trade. So the price went to the stop loss, it was literally a couple of ticks, I think, away, and then it didn't stop me out on this first leg down. Then the price went up. It almost went to the sell limit, but it didn't really, and then I was stopped out on the way down. So I lost how many points was that? 12 points on this trade. And on the second trade, it was a break even trade. So you can see here, this was the afternoon session, and the price basically hit the limit order first. As you can see here, I took a 1-to-1 risk to reward trade for half of the position, and then I let the other half run. And then the price actually went down, and then went up again and hit my stop loss. So in the first scenario, my long trade was here, my stop loss was here, and this is my stop loss, this is my entry, and the price didn't really survive the limit order, so it went down, then up and down, and then eventually it stopped me out. So this was a losing trade with 12 or so points, minus 12. And on the other trades, I had it was a short trade, so this was my entry, my stop loss, and my limit order for 50% of the trade. So this was my stop loss, this was my 50% buy limit order, and this was my entry here. And what happened here was that the price actually went down, hit the buy limit order, and then it just started hesitating and went up and hit the stop loss. So I didn't lose anything on this trade, so my loss was 0, and I ended up the day pretty flat. So it was only minus 12 points a loss, but a couple of things that I didn't really follow and which led to those losses. Usually we don't have that many losses or loss and a break-even trade in a row, but one of the things that I have this rule which I sometimes break, and every time I break I actually kick myself for it, is that during an FOMC day we are not supposed to place any trades before the announcement. So before the FOMC announcement comes, and then not even then maybe another 15 minutes later, we are kind of okay to trade, but not between those 15 minutes or any time before the FOMC announcement. So if this is the FOMC announcement, I'm waiting on theory 15 minutes and then I'm trading. In this occasion, my mistake was that I actually placed the morning trade and then the afternoon trade, and I ended up the day with a total of minus 12 points, which again is not the end of the world, but what hurts most in these occasions is that you are not actually following your own rules. You know precisely that every time you've broken the same rule, it actually is biting you back. So I didn't really do that on this occasion as well, for which I'm not really happy. I wanted to share it with you to make you a part of this journey, and I'm sure that lots of you are doing the same mistake. But again, my hard rule was still intact, so not taking more than 3 trades a day. This is the very top limit of the amount of trades I'm supposed to take. Usually, I'm only taking 1 to 2 trades a day, and this is a day trading strategy. And the reason being is because in most cases, if a trade is profitable, we're just holding it for the whole day, and sometimes even for longer than 1 day. But this is the reality, guys. So if there is one thing that you should take away from this video, is that if you are, no matter what system you're using, just pay attention to the FOMC days. Is your system as as profitable during an FOMC day, not trading the event itself, the announcement, but trading during the day? If it's not, then maybe you should consider to stop trading for the whole day, and only look at the markets after the announcement is out there, and then after the markets have settled down a little bit. So these are my 2 cents, guys. If you have some questions or comments, just write them in the comment section below. Thank you. Bye.